We have Rachit Chawla, the founder and CEO of Finway FSC, joining in. Rachit, thank you so much for taking our time and joining us today on the Money Show. To start with, Rachit, we've seen debt funds return very poor returns in these last couple of months. A long duration fund especially is in the negative. Just a percent or 0.5% of gain seen in some short duration funds, medium duration funds, maybe a little bit here and there. Rachit, what's the reason that debt fund holders have had to, deal with such poor returns so far?
So thank you for having me on the show. So basically, the way debt instrument works is that you are lending money to mutual funds so that they can lend it further. But as you have seen that RBI is continuously reducing the rate of interest. Hence, that debt becomes very cost effective for the corporates or anybody that mutual fund lends it to. Since the rate of interest is continuously going down, hence, as a customer, you will also get the same rate of interest. So if the mutual fund is earning less, in your hands also, you will be getting the same rate of interest. And as you see, since, we all have been hit with pandemic, RBI's interest is to ensure that consumption is still there. And I think lower rate of interest would really help increase the consumption. And that is where we are. Hence, the debt fund is, unlikely that they would give a better yield. That's when you see, continuously reducing the ROIs in terms of hands of the consumer.
Rachit, what is the outlook then for the rest of the year? Because the RBI does not look like it's going to increase interest rates for the next few months. Last night we had the Fed as well saying that interest rates are still a long time away, maybe 2 years later, of course, because of inflation, etc. They've increased the number of interest rate hikes. But yeah, even the US central bank is saying that, okay, no rate hikes for the next 2 years. So largely, the RBI is not going to increase interest rates. So does that mean bond yields as well will continue to stay low and debt fund holders will have to deal with these lower returns for longer?
Yes, so if we see a very short-term horizon, I also don't see the interest rate rising up. In fact, yesterday in the Fed meeting, it was very clear that interest rate will get revised only in 2023. And having said that, that's also if this pandemic gets in control. At the moment, we still don't have the pandemic control because, for a population of 120 crores people, vaccination is still far away. So it will take a lot of effort. And in terms to keep the economy running, I really doubt it that RBI will say that we are going to increase the interest rate. And if RBI doesn't increase the interest rate, but obvious that the debt funds also will not be able to yield you high rate of interest.
So, we have seen long duration and medium duration funds bear the most brunt in this last few months. So if you could explain to our viewers how exactly does it work? Is it that the longer duration debt funds are going to feel more of a pinch, and maybe that's why you should enter more shorter duration and liquid funds?
So nobody saw COVID coming. Nobody saw that this pandemic will shape the way it has. And it's already been almost 1.5 years in the pandemic that still we are seeing a lot of uncertainties. The way it works is if you see December 2019 or maybe, October 2019 for that matter of fact, the rate of interest on these debt instruments was somewhere around 8%. As the pandemic hit us badly, it was in the best interest for the economy to pump in more and more liquidity so that economy can survive and can go through this difficult time. Now, what has happened is, in order to sustain that, RBI kept on decreasing the interest rate so as to increase the liquidity. Now, when you decrease the interest rate, when in October 2019, people were getting around 8% yield, that started coming down. And since last 1.5 years, it has come down by a significant portion from 8% to 5%. So there's a gap of almost 40%. The yield has reduced. Now, people who might have entered at that point of time would have suffered the most. In the longer run, obviously, the average has gone really bad. In the very, very short term, if somebody is investing now, for a longer term, I think the average will not be that worse what we are seeing in the past. Because from here, I think since we have the vaccination, economy should rebound. If economy rebounds, then obviously interest rate will go high because the RBI will also have to control the inflation. So they cannot keep interest rate low for a longer time of period. They have to increase it so as to adjust with the inflation. So to answer your question, people investing now long-term debt might be a good entry point for them.
Okay, but you have to, if you're looking at investing in debt funds right now, then maybe a long duration fund could be a good bet. Rachit, what about those individuals who already have their money lying in debt funds? What kind of rejig would you recommend? Let's say a little bit in long duration, a little bit in short duration. Existing investors, should they then in that case stay put with where they are?
So if somebody has invested with a rationale of really long term, I think they should stay invested because they have reached a cycle where the interest rate have actually hit the bottom. So, they have already sailed through the difficult times. But people who actually entered for a shorter duration, say 3, 4 years, and I think for them, it would be a wise option to look out for other options and not be stuck because there's like for 3, 4 years of time horizon, only 2 years is left for those people. So I think it would be a good idea for the short term investors to look out for different options that are available in the market. For longer term, I would still feel they should be invested in this instrument as they've already seen the low hit very hard.
All right. Okay, understood. Do you think, Rachit, with the expected returns in this year from debt funds, we already do know what FDs are yielding, right? Barely 5 to 6% in terms of a 1-year FD. With such low interest rates, Rachit, do you think that a fixed income portfolio can actually manage to protect an investor's purchasing power? For younger investors, yes, we have time on our side and we can invest in equities, and that's a great way to protect your purchasing power. But the rate of inflation it's crazy, right? If we look at oil prices, vegetable oil prices as well, a simple household item has been soaring, and how pulse prices have been soaring. And the latest reading was 6% back home. Do you think that for somebody who's perhaps got a shorter time duration, perhaps senior citizens, do you think debt funds can no longer cover and protect your purchasing power of your cash against inflation?
At the current scenario, definitely it's very challenging for them because inflation is beating the returns that they are getting. Again, it depends on the objective. I mean, if the objective is long term, I would suggest to stay invested. If the objective is short term, near term, between 2 to 5 years, I think one should definitely explore other options. I would also like to add that this has been the problem with fixed deposits or debt mutual funds since the very beginning, because they give a standard return which is towards the lower side, and inflation is very volatile in a developing country like India. Generally they are not at par, the debt instruments that they can invest in, not at par where inflation can be beaten easily. That's why I recommend that everybody should have certain portfolio in corporate FDs, which yield a better rate of return, somewhere around 8 to 9%, or perhaps they should explore other options. But definitely inflation needs to be beaten. Otherwise, ideally, what you're doing is you are, you are investing the money, but end of the day, that money isn't growing. That money is getting depleted slowly and slowly.
What do you think? I know you mentioned corporate FDs, etc. What do you think of the government saving schemes? Because most of them seem to be offering at least a 6.5% interest rate. And the biggest positive, apart from the fact that, of course, it's sovereign backed and it's backed by the government, so there's absolute no fear of credit default. It's an instrument that's writing the interest for you in black and white, so it's not subject to market risks. So how would you judge that, investing in that right now versus maybe debt funds?
So that is definitely a good option since it's backed by government securities. So it's very safe. One can invest there. In fact, one should also explore the option of investing in monthly liquidity scheme, which also is termed as monthly income generating scheme. So what will happen is the money you get from these securities will be credited every month on month. So you will have a lot of liquidity in your hands in such difficult time. I feel these kind of post office monthly schemes, these schemes really come handy. So people looking for alternative, definitely government backed securities is a very good option. Monthly income schemes is a very good option. Also, they could look at investing in corporate bonds of companies which are AAA plus rated. Those companies, who have negligible debt and are still giving a decent, ROI on your investment. So that could also be one option to look at.
Okay, well, that's enlisting all the other options that you could look at investing if in case, you're a little skeptical of putting your money in debt funds. Remember, we are in a low interest rate environment, so unfortunately, we will have to contend with these kind of returns for a while now. Not just in debt funds, but even in all the other government-backed security schemes, when the interest rate in the environment tends to be on the lower side. Unfortunately, so does the income for fixed income investors. Okay, well, ladies and gentlemen, let me remind our viewers that this is the show that answers your questions and queries. So if you would like to ask Rachit anything, from our conversation that we just had on debt funds, you can shoot us an email on themoneyshow@etnow.tv. Okay, well, let's take on board our first question. It's from Shivakumar Burli. He says, can we expect the average of coupon rates if we hold for 1 year and above from short-term debt funds? Firstly, Rachit, I reckon many may not be knowing really what is coupon. It's just a fancier way of saying interest. But what is the funda behind short-term debt funds? How exactly do its movement affect interest rates and affect the eventual return for the investor? If you could also help out Shivakumar with his question.
Sure. So think of it that the consumer is becoming a bank and he's saying, I've got certain amount of money which I will lend it to you. Now in that case, the bond might be backed by the government security or a corporate bond, in that case backed by a company. So that company discloses that this is the rate of interest that I am willing to give it to you in return of the money invested with me. So that rate is called a coupon rate. Ideally, just a return on your investment. But that coupon rate is also sometimes subject to volatility. When I say volatility, it means from time to time, it will go up or it will go down as per the situation of the economy. So RBI comes into the picture. RBI has to control inflation on one side and RBI has to ensure that the GDP also grows. The way GDP grows is when consumers have enough liquidity in their hands. So what we have witnessed right now, pandemic happened, liquidity got eroded, consumers did not have any liquidity to spend. And RBI saw that the GDP is continuously dropping because the end consumers is not investing or buying goods and services, across India. What they did was to lower the interest so that consumers can borrow money at low rate of interest and continue to spend money in the economy by way of either purchasing services or goods. Now, real estate would be a very good example to give right now. So suppose there's a house which a consumer really likes and it's for 10 lakh rupees, but the prevailing rate of interest is 8% per annum. Maybe the consumer thinks, no, I cannot buy this house right now because I'll have to give 80,000 rupees per annum just as interest. So RBI steps in and he tells that, okay, let's reduce the interest to as low as 5%, so that you only have to give away 50,000 per annum as interest. The consumer will automatically buy that property and increase the GDP of the country, because the consumer feels that, okay, that interest is well within the budget. This is how the cycle continues, wherein RBI actively manages both the sides, both the parameters. Now, in case of the coupon rate, that also reduces and increases as per the policies of the RBI. In short term, less than 12 months, I think it can not get very tricky. But if you're investing over a period of 3 to 5 years, it can get very tricky, because you've already agreed the coupon rate and the economical factors are totally not in your control. Hence, for a short term, I think you don't have to worry about it. If you're looking for next 12 months, I think you can go for it. But for a longer term, you definitely need to get your objectives right and understand the implications and the variations attached with the volatility of any dynamic economy.
Okay, all right. Well, I think you've explained that really wonderfully, Rachit, and I'm sure it's helped viewers take that first step towards understanding fixed income and how the entire world of fixed income investing and bond markets work. And I hope it's answered Shivakumar's question as well. We've just got a brand new question coming in from Subramaniam Pichai. It's in fact a very relevant question. He says, now inflation is almost 6%. What's your view of investing in balanced advantage funds instead of debt funds? Now he's saying that his retirement corpus is a good 50 lakh rupees. What money one is able to withdraw monthly and for how many years? Okay, I'm not sure what exactly is he trying to say. I think he's trying to say that if he puts this entire money in a balanced advantage fund, how much will he be able to withdraw, if I'm not mistaken. But let's at least answer the first part of the question, Rachit. What is your opinion of balanced advantage funds? Do you think that's a good way as well to tackle inflation, which Mr. Pichai has rightly mentioned is now crossing 6%?
Yeah, so I feel for any investment, the consumer needs to understand what are his objectives. Now, all these schemes are good in their respective segment, but there are free websites like Money Control or valueinvesting.com, which has got data of all the mutual funds across the globe. So you can just log on to those websites and check what kind of returns are those funds giving you. Because if you feel that balanced fund is the right one, you need to understand the historical data. Moreover, you need to see the peer comparison also. If it fits in your parameter perfectly, you should go ahead with it. But before going ahead, please do see what are the expenses attached to it. How are the peer companies performing? Is it meeting your objective criteria in the longer term, also forgetting the shorter term? So your analysis need to be spot on. In a country where inflation has gone 6%, I would also strongly suggest that balanced fund can turn out to be a very good option, provided you invest in the right balanced fund and not any balanced fund. That can also be seen on websites, the way those balanced funds are performing, because you might come across certain balanced funds which are not performing as well as the peer balanced funds.
Okay, well, that's the view coming in on balanced funds and the suitability as well of the same. Remember that when you consider investing in different funds, you have to look at a variety of things. It's very subjective. What's suitable for Mr. Pichai may not be suitable for somebody else. So yeah, it's always good to also personally consult a personal finance advisor. Okay, we I think have time for one more question perhaps. Balakrishna Shetty writes into us saying, kindly share a retirement plan for somebody above 65. Currently my savings are in a bank FD meant for my future expenses, and also in a construction project which is now under insolvency. So I reckon that he's put some money, he's tried to purchase a property, but maybe the property now is in the doldrums, or the developer has not been able to complete it. He has 25 lakh rupees that he wants to invest, and he's 65 plus. So is a bank FD the only option available for 65 plus? What are the other options?
So I think you should not look at only one instrument at 65 plus. I think certain banks are giving very good fixed deposit rates for senior citizen. They also have monthly income plans associated with their instruments, so that you also have certain liquidity to take care of your daily expenses. I've already mentioned that post office savings scheme is also a good option, wherein they give decent amount of return as well as monthly liquidity. So I would recommend you to divide your investment into three categories. Since you mentioned about construction and that company has gone insolvent, there might be that somebody else takes it over, and you might have to pay some amount to them, as a solution for completing the project. So I think 30% you can keep your money in liquid funds. Generally, liquid fund gives you around 6% per annum, but these are easily redeemable, no exit load whatsoever. Remaining 30% you could probably put in a scheme that gives you a monthly return, a post office scheme or any government scheme, so that your liquidity is taken care of. Remaining 40%, you can actually look at certain FDs specifically meant for senior citizen, wherein you will get a higher ROI as compared to a person below the age of 60 years. So I think you need to divide your money, because the future, it's a bit uncertain with your construction money getting blocked, but that would help you sail through this difficult time.